You know that feeling when you finally decide to buy something, and the very next day, the price drops as if the universe waited for you to commit, before moving the numbers in the opposite direction, like you were meant to lose just a little bit of money without noticing. Now imagine that same feeling stretched across your entire financial life. Imagine discovering that the rules around you had shifted quietly, silently, without any warning, and somehow the future you thought you were building had become smaller, tighter, more difficult. Not because you made a mistake, but because the system behind you adjusted itself in a direction that benefited someone else. And the most unsettling part is that it all happened while you believed you were doing everything right. This is the hidden reality of modern banking, a reality most people never see because they are not meant to see it. There is no dramatic announcement when it happens. There is no flashing sign. There is no news alert telling you your financial trajectory has just been nudged off course. It happens in an invisible way, through a loophole so subtle and so perfectly legal that it blends into the background of everyday life. And yet its influence is enormous. It has the power to shape how much you save, how much you lose, how much you borrow, and how much you will or will not be able to afford 10 years from now. Most people believe banks exist to protect their money. They imagine banks as partners, as guardians, as institutions that stand between them and financial chaos. But the truth is, banks operate on an entirely different incentive structure. Their job is not to protect your financial future. Their job is to protect their profits. And once you understand how those profits are created, you will see why the loophole they discovered is so effective, and why so many people feel like they are falling behind, even when they are doing everything that seems sensible. So make sure to stay until the end to understand how to use this system to your advantage. Leave a like, and let's start. To understand how banks manage to influence your future so smoothly, you first have to understand how they think. Banks do not think in months or years the way most people do. They think in decades. They think in cycles. They think in streams of predictable income flowing consistently over time. And once you understand this, you begin to see why so many financial products are structured the way they are. They are not designed around your needs as much as they are designed around the bank's long-term expectations. Take something as simple as a savings account. On paper, it looks like a place where your money can grow slowly and safely. But if you look more carefully, you realise something strange. The interest rate is so tiny that it barely matters. You might save for a whole year and earn only a few dollars. Now, this is not an accident or poor design. This is part of the structure. By offering extremely low returns, the bank nudges you away from saving and toward borrowing without ever saying it out loud. If saving feels pointless, people naturally look for alternatives. And alternatives, in the banking world, almost always benefit the bank. This is the psychological side of banking most people never see. Banks do not need to force you into debt. They just need to create an environment where debt feels normal, feels necessary, feels like the only option left. And they achieve this by adjusting the incentives around you so slowly and subtly that you respond automatically, without even realizing the path you are being guided down. Think about mortgages. They appear to be simple agreements. You borrow money, you buy a home, you pay the bank back over time. But the deeper truth is that mortgages are structured to maximize interest in the early years. The bank collects the largest share of its profit up front, when you are least aware of how much interest you are paying versus how much principal you are reducing. You may think you are steadily building equity, but the structure shows a very different picture. For many years, you are mostly paying interest, not owning more of your home. This is intentional. It ensures the bank receives the majority of its reward long before you experience the majority of your benefit. But the loophole goes even deeper than that. Banks learn that they do not need to push you into any specific decision. They only need to shape the environment in which you make decisions. If that environment makes saving feel too slow, or borrowing feel too convenient, or financial progress feel too difficult, then the outcome becomes predictable. Most people will end up taking the path that benefits the bank the most, and that is how the manipulation works. Quietly, legally, invisibly. Now here is where things become truly fascinating. The loophole banks use is not about a single fee, or a single rate, or a single contract. It is about the ability to influence the entire rhythm of your financial life through micro adjustments that you barely notice. A small fee here, a tiny rate reduction there, a new loan structure that looks flexible, but extracts more over time. It is death by 1,000 paper cuts, except most people never see the cuts. They only feel the slow weakening months or years later. Take credit cards, for example. Everyone talks about high interest rates, but the real weapon is minimum payments. Minimum payments are designed to look harmless, as if they are there to protect you, to give you breathing room. But they do the opposite. They stretch your debt across years, sometimes decades, while the bank quietly collects interest the entire time. And because the minimum payment feels doable, you feel safe, even as the bank quietly molds your financial horizon into something that benefits them, not you. Or look at overdraft protection, a feature that sounds generous. It promises to save you from bounced payments or declined transactions, but in reality it is a fee machine. A legal trap disguised as a favour. The bank allows your account to dip negative by a tiny amount, then charges a fee that is often larger than the entire negative balance. To them, it is a predictable income stream. To you, it is an invisible drain. And then there is the way banks adjust their interest rates on loans versus savings. When you borrow, interest moves upward quickly, aggressively, immediately. When you save, interest moves downward slowly, quietly, without explanation. This is not random, this is not market coincidence. This is a carefully structured environment in which the bank always earns more from your borrowing than from your saving. And the incentives are aligned to push you toward the behaviour that produces the most profit for them. But again, this is not the whole loophole. These are pieces. The loophole itself is something more subtle and more powerful. And it works not just because the bank changes products, but because the bank changes expectations. If you expect low savings returns, you will not question them. If you expect high loan rates, you will accept them. If you expect fees to exist everywhere, you will tolerate them. Banks understand human psychology deeply, and they know that expectations are easier to manipulate than outcomes. If you alter what people believe is normal, you alter their financial behaviour for life. This is why so many people feel like financial progress is always slightly out of reach. They work, they save, they follow the rules, but the system is built in a way that moves the finish line a little farther every time you get close. Not dramatically, not obviously, just enough that you feel the strain without seeing the cause. And this is the quiet brilliance of the loophole. Banks found a way to influence long-term financial outcomes by controlling short-term experiences. They know that if they can shape your emotions today, they can shape your decisions tomorrow. If they can make you feel frustrated with saving, or comfortable with borrowing, or resigned to fees, then they have effectively manipulated your financial future without ever forcing your hand. Consider how people use accounts today versus 30 years ago. Savings accounts once felt meaningful. Today they feel almost symbolic. Loans once felt intimidating. Today they feel like a normal part of adulthood. Fees once felt unacceptable. Today they feel inevitable. Expectations shifted, behaviour shifted, and the banks benefited from every shift. Now imagine this influence stretching across decades. Small disadvantages accumulate. Small fees multiply. Small gaps widen. And before you know it, the financial life you expected to have looks very different from the one you ended up with. Not because you were irresponsible, not because you were naive, but because the system was designed to tilt your trajectory in a direction you could not see. This is the reality millions of people live in without realising it. A reality shaped not by dramatic actions, but by subtle mechanisms that extract value quietly, efficiently, and legally. It does not feel like manipulation because it never announces itself as manipulation. It feels like normal life. But normal life was engineered, and once you understand that, everything starts to look different. There is a moment in everyone's financial life when they pause and wonder how things became so complicated. Not because a disaster happened, not because they were reckless, but because the numbers they expected to work in their favour somehow refused to move. It feels as if something beneath the surface is pulling against them, turning every step forward into a struggle. This is where the deeper layer of the banking system reveals itself. A layer built not through secret meetings or shadowy deals, but through ordinary mechanisms that people interact with every single day. These mechanisms look harmless on paper, but together they create a structure that bends financial outcomes the same way a slow current bends a river over time. And the most powerful part of this structure is the loophole that allows banks to do it legally while the public remains unaware of how much influence is being exerted over their futures. To understand this loophole clearly, you have to start with the way banks view risk. Most people believe risk is something unpredictable, something emotional, something that changes with life events. Banks do not see risk this way. Banks quantify risk down to decimals. They convert behaviours into predictable patterns. And more importantly, they discovered that by adjusting the environment in which people make financial decisions, they can shift those patterns in ways that make people behave more predictably, which then makes the bank's profit streams more reliable. This is the loophole, the power to engineer predictability. For example, when interest rates on savings accounts are extremely low, banks know people are more likely to use credit to manage expenses. They know people will carry balances longer. They know people will renew loans rather than pay them off aggressively. They know that if saving feels unrewarding, spending will feel psychologically easier. And once this behaviour becomes normal, it becomes measurable. Once it is measurable, it becomes profitable. Every fraction of a percent in interest charges becomes part of a stable and predictable income stream. But the loophole is not simply about nudging people into debt. It is about the ability to design financial products that appear helpful while quietly shifting long-term outcomes. Take adjustable rate loans. They are marketed as flexible solutions that allow people to start with lower payments. The presentation feels comforting, almost supportive. But the structure hides a critical detail. Banks know that when the adjustable period ends, rates are likely to rise. They know people often feel too committed to their homes or lifestyles to walk away. They know the borrower's future choices become limited, and this limitation is profitable. The borrower feels trapped. The bank feels secure. Another example is the way fees are distributed across everyday banking. No single fee seems threatening by itself. A maintenance fee here, a transaction fee there, a small penalty for being a few dollars short one afternoon. None of these feel catastrophic, which is exactly why they work. Banks rely on the fact that individuals assess financial harm emotionally rather than mathematically. A large fee creates outrage. A small fee creates resignation. And if resignation becomes normal, the bank gains a steady stream of revenue that the customer barely notices. The loophole allows banks to turn thousands of tiny financial inconveniences into millions of dollars in annual profit without ever appearing aggressive. Yet the most fascinating part of this entire system is how banks learn to manipulate time itself. Not in a science fiction way, but in a structural way. Banks realize that if they could stretch a borrower's timeline, they could stretch their own profit timeline as well. A loan extended is profit extended. A repayment slowed is revenue stabilized. This is why so many people find themselves paying far more in interest than they ever expected. The bank is not merely lending money, the bank is selling time. And time is the most expensive product they offer. This becomes even more evident when examining how banks structure payment schedules. When a person pays a loan, they imagine themselves gradually shrinking the amount owed, but the payment structure often prioritizes interest first and principal second, especially in the early years. This design means the borrower feels productive, while the bank collects the maximum possible reward before the borrower accumulates meaningful equity. It is a psychological illusion, a quiet rearrangement of expectations. The bank does not need to trick anyone. It just needs to present the structure attractively enough that people accept it without questioning the math. Consider also how banks shape financial culture. People grow up being told that credit is essential, that a high credit score determines their future, that borrowing is a normal part of adulthood. What most people do not realize is that credit culture benefits banks more than borrowers. A world where everyone pursues debt is a world where banks remain indispensable. And by embedding credit into the fabric of society, banks eliminate alternatives. It becomes harder to imagine a financial life that does not depend on interest payments. This is a form of psychological infrastructure, and once it is built, the loophole thrives within it. The loophole is not built on deception, it is built on control. Control of what people think is normal, control of how people experience money, control of how people interpret their financial choices. And once the bank controls the environment, it controls the outcome. A consumer saving 5% of their income today is not the same as a consumer saving 5% 30 years ago. The environment changed, the incentives shifted, the structures adapted, and the bank ensured those adaptations worked to its advantage. You can see this even more clearly when you examine the relationship between inflation and interest. When inflation rises, the value of money saved decreases. When interest on savings stays low, the pace at which savings grow cannot keep up. This gap between inflation and savings returns is not just an inconvenience, it is a quiet extraction of wealth from those who rely on traditional banking products. Banks know that most customers will not seek alternatives. They know habits are powerful. They know familiarity feels safer than change. And this is where the loophole tightens. By offering products that appear secure but fail to protect customers from inflation, banks effectively shape financial outcomes while claiming they did nothing except present available options. Look at auto loans as another example. Cars depreciate. Loans accumulate interest. The borrower often ends up paying more than the car is worth long before the loan ends. This creates a recurring need to borrow again when upgrading a vehicle. The cycle repeats. The bank earns, the borrower restarts. The loophole does not require the bank to mislead anyone. It only requires the borrower to follow patterns that feel normal in modern society. Even the way banks frame convenience is part of the structure. Features like automatic payments, digital wallets, contactless transactions, and instant transfers make life easier, but they also make spending frictionless. When spending becomes effortless, borrowing becomes natural. And when borrowing becomes natural, interest becomes unavoidable. Convenience is a tool. It is presented as a gift. But it is also a gateway to consistent profit streams. The loophole thrives in convenience because convenience bypasses critical thinking. The same principle applies to subscription models tied to debit or credit accounts. Banks know that people forget about recurring charges. They know companies rely on that forgetfulness. They know fees triggered by insufficient funds are more likely when multiple subscriptions hit an account across a month. This chain reaction of charges and fees appears accidental, but it is predictable, and predictable behaviour is profitable behaviour. Banks also understand that the average person struggles to visualise long-term consequences. A 2% difference in interest seems meaningless in the moment. Over 30 years, it is massive. A tiny monthly fee feels minimal. Over decades, it drains thousands. The loophole works because people make decisions based on what feels manageable today, rather than what becomes significant over time. Banks design around this tendency, ensuring their profit grows as the customer's long-term loss compounds quietly behind the scenes. This entire structure becomes even clearer when examining the way banks treat financial hardship. When someone struggles financially, the bank's response is not compassion, it is structure. Late fees, penalty rates, extended timelines that generate more interest. The bank does not need to punish anyone. The system is built so that hardship naturally channels more profit toward the institution. It is not personal, it is structural. And that is what makes the loophole so powerful. It functions regardless of your intentions, your effort, or your discipline. Yet despite all of this, the most surprising part of the loophole is how easy it is to miss. It hides inside products people use every day. It hides inside assumptions people never question. It hides inside habits inherited from parents and communities. It hides inside numbers small enough that they never trigger alarm. And by the time someone realizes how much influence the system has had on their future, years may have passed. This is why understanding the structure matters. Not to fear banks, not to hate banks, but to recognize that your financial life is shaped by incentives you did not create. Once you see the structure, you can navigate it more intelligently. Once you recognize the loophole, you can avoid becoming part of its predictable pattern. And once you understand how deeply banks rely on shaping your behavior, you can begin shaping your own path instead. The system is powerful. The loophole is subtle. But awareness is stronger than both. The truth is that the financial world is not shaped by dramatic events, but by quiet mechanisms that most people never see. And once you understand how banks use structure, incentives, and psychology to influence your decisions, you begin to recognize how easily a person's future can be shifted without their awareness. The loophole was never about breaking rules. It was about shaping expectations so subtly that people follow paths designed for them rather than paths they choose for themselves. And this understanding alone gives you more power than most people ever realize they have. Once you see the system clearly, the illusion disappears, and the decisions that once felt automatic begin to feel intentional again. Your financial life becomes stronger. The moment you stop accepting everything as normal and start questioning why things are designed the way they are. Because banks thrive when you operate on habit, and they lose leverage when you operate on awareness. When you understand how the environment influences your behaviour, you begin to redesign that environment for your benefit, choosing products that protect your future instead of draining it, building habits that compound in your favour instead of someone else's, and turning the quiet forces that once worked against you into forces you finally understand and control. If you want more financial literacy, make sure to subscribe and click on the next video. Oh, anyway, I opened a new completely free community where I explain how to create and scale your YouTube channel. After an experience with over 10 successful channels, there I will give you all my strategies and tips to monetize and scale your faceless YouTube channel, and I will help you step by step, since YouTube is the golden opportunity of 2026 if done well. I'm waiting for you. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.